Big pop in equities as a result of this today. What do you make of that? What does that tell you? What is the market signaling? Is that just a kind of a 1-2 day phenomenon? Do you think that's got legs? What do you think happens to other asset classes in more detail, particularly equities?
Well, we had a meaningful correction leading to this week's rebound. And in the same spirit of more balanced risks, I think after meaningful correction, maybe there is just a little bit of pent-up desire to kind of get back into the market. Our view is still that we have to be selective in terms of where we deploy risk, because risk assets, equities, have yet to price in the entirety of what this new regime means, which is higher rate and potentially lower trend growth, and the need for selectivity is still high, which is why we continue to like sectors like technology. Even though there is huge dispersion in terms of earnings season, it's still driving most of the earnings growth in the current reporting season. We also like selective markets. UK, very cheap. We recently turned neutral, and Japan, we are overweight. We upgraded it twice, but for the broader market, we need to see greater repricing to reflect the new regime before we say across the board we like it. Right now, we're still quite selective.
So what do you then think is the biggest misprice in the market? If we take it back to the cut or hike conversation, is it that we're going to have to see more cuts faster because economies roll over, or is it the fact that we need to push out those cuts to 2025? Where do you think the balance of risk is in this?
I would say that in terms of where markets are pricing for policy path, it's actually largely in line with where we saw policy path should head towards at the beginning of the year. So at the beginning of the year, there is a delta between market pricing and our expectation, but now that has meaningfully moved closer to our expectation to the extent that there's no delta difference really in terms of policy path. But to your point about where the mispricing is, I think credit spread is very, very tight. If you look at how much 10-year has repriced since the beginning of the rate hike cycle. IG spread has held up really well. High yield spread has held up really well. We like them through the rate hike cycle, but right now, as we want to kind of take advantage of the meaningful repricing in other parts of the market, for example, turning neutral on duration, turning positive on duration in UK as well as Europe, we are funding that out of credit because the spread has really tightened meaningfully in the grand scheme of things.
A lot of people are in cash. Is the trades you're talking about, is it time to take money out of cash and put them into those trades right now?
I think at some point we'll be advocating in a huge way to deploy cash, to put cash to work. But right now, at this current juncture, risk assets have yet to fully reprice for the new regime.
How long do you think that process takes?
Well, it depends on how markets move in the interim. So we have already talked about kind of moving from the very front end of the curve to now liking duration in UK, in Europe, and also parts of US as well. So we're already kind of starting that journey in duration. We have yet to do that across the board with equity. We're doing that with selective parts of equity, as I said, and also private market being very selective in terms of where we deploy risk. So private credit stands out versus the other private market exposures.